If you already own stocks like Apple, Nvidia, Google, or any other long-term investments, there's a strategy that can potentially generate extra income from those shares without buying anything new. It's called a covered call. Most investors either don't know about it or assume it's too complicated because it involves options. But the truth is, once you understand the basics, it's actually one of the simplest option strategies out there. In this video, I'm going to explain exactly what covered calls are, how they work, how people use them to generate income, the risks you need to know, and when they actually make sense. By the end of the video, you'll know whether covered calls are something worth adding to your investing strategy. What is a covered call? Let's start with the basics. A covered call is an option strategy where you already own at least 100 shares of a stock and you sell someone else the right to buy those shares from you at a specific price before a certain date. When you sell that option, you immediately receive money. That money is called the premium. The reason it's called covered is because you already own the shares. If the buyer decides to purchase your stock, you already have it, so you're covered. For example, let's say you own 100 shares of Apple. Apple is trading at $200 per share. You sell one covered call with a strike price of $215. That expires in 1 month. Someone pays you $250 for that contract. Whether Apple goes up, down, or stays the same, that $250 is yours to keep. That's the basic idea. You're getting paid for agreeing that if Apple reaches a certain price, you're willing to sell your shares. So while you're collecting premium, they're betting on a big move higher. So there's different outcomes and different ways on how you actually make money. Let's look at 3 different outcomes. Scenario 1, the stock stays below the strike price. Let's say Apple stays around $205. Your strike price was $215. Since Apple never reached that, the option expires worthless. The buyer loses what they paid for the option. You keep your shares and keep your premium. This is the outcome most covered call sellers hope for. Scenario 2, the stock goes above the strike price. Now imagine Apple jumps to $225. Since your strike price was $215, the buyer will likely exercise the option. That means you'll sell your shares for $215 even though Apple is trading at $225. You still made money because you earned the premium and you earned that gain from $200 to $215. But you missed out on the additional gains from $215 to $225. That's the trade-off. Covered calls limit your upside. Now, scenario 3. The stock falls. Suppose Apple drops to $185. The option expires worthless. You still keep the premium, but your shares lost value. The premium helps reduce your loss slightly, but it doesn't protect you from a major decline. Covered calls generate income. They're not insurance against falling stock prices. So why do investors use covered calls? There are many reasons why investors use this strategy. First, it creates additional income. If you already own stocks for the long term, selling covered calls can provide extra cash while you're holding them. Second, it can slightly reduce risk. Because you're collecting premium, it lowers your cost basis by a small amount. That won't eliminate losses during a market decline, but every dollar collected helps. Third, it works well in markets that aren't moving much. If a stock trades sideways for months, covered calls allow you to keep generating income while waiting. Instead of your shares just sitting there, they're producing cash flow. Like every investing strategy, covered calls have advantages and disadvantages. The key is understanding exactly what you're giving up before using them. If you found this video helpful, consider subscribing because I post videos and break down investing concepts in a way that's simple and practical. That's all for today's video. Thanks for listening.